Alrighty, what is going on, everybody? Welcome back to another CYPRX educational video breakdown. In today's video, we are going to pick apart the markets, i.e. the cryptocurrency asset class as a whole, going over the total cryptocurrency market, explaining to you all in extreme detail why we've seen a massive outflow of risk assets, particularly in crypto, over the past consecutive couple of weeks, what has started all this, physically showing you guys on the charts my mind map, pinpointing all the fundamentals and how price reacted to the fundamentals given the risk on, risk off market sentiment. This is going to be an in-depth educational video breakdown. This is not going to be for you bullish moonboy hopium traders or investors. This is going to be for you investors and traders that are actually looking to further your education and your knowledge about this market and why we've seen this most recent decline in price action. So if you all enjoy these video breakdowns and you actually enjoy learning about the markets in which you operate in via fundamentals and why price is doing what it's been doing over the past consecutive couple of weeks, we're going to go all the way back to when the cryptocurrency market topped out and start there and work our way up to where we are currently at this moment in time as of recording this video breakdown. Then do us a favor, smash that thumbs up button and subscribe. Now I'm going to take my time. I'm going to attempt to talk with a monotone, number one, because I'm feeling a little bit under the weather. My throat chakra is a little bit jacked up from all the content that I make, and I'm unable to speak very enthusiastic. But this stuff is extremely important for you all to know. So before we get into the most recent decline in price action, understanding why we've seen risk assets across the board, particularly crypto, for example, you can see all the assets in my personal portfolio are in the red right now. And I'm sure that as of time of recording this video, yours are most likely as well. Vast majority of manual retail investors on the internet have no idea what's going on or why they're seeing a depreciation or a discount in prices as of right now. So make sure that you're paying attention. Now, if you want to understand how we got to these highs and what drove risk sentiment all the way up to the point where the cryptocurrency market cap just most recently topped out at about $2.7 trillion, go over to our YouTube channel, click on the video section, and scroll all the way down here to a video that we uploaded about a month ago labeled Interest Rates Crypto Bullish Effect. And I did the same exact thing explaining to you guys pinpoint accuracy in the form of fundamentals, showing you guys on the charts all the way back from November 2022, leading up to where we were currently at time of recording that video breakdown, showing you guys why risk assets were bullish, utilizing fundamentals and pinning them on the charts, going over in detail how we got to the point of a $2.7 trillion market capitalization before we started to peel out and see a depreciation in value. So again, go back, scroll down. XRP crypto boom is the thumbnail. Interest rate cuts crypto bullish effect is the title. Got about 3.3 thousand views, uploaded a month ago. Go back and watch this episode first before you watch this one. All right. Now, to grasp this video breakdown, it is absolutely essential to first understand the primary drivers behind the surge in risk asset buying over the past year, particularly in stocks and cryptocurrencies. That is our focus for today's video. This bullish trend has been largely fueled by the widespread belief that central banks globally will implement rate cuts. This is obviously, of course, excluding the demand for Bitcoin that we've seen due to the ETFs and whatnot. I'm just focusing on the macro. The market, particularly in crypto, has thrived on speculation about potential rate cuts from the Federal Reserve, resulting in an optimistic outlook. Now, let's first dive into the fundamentals supporting this rate cut narrative, some factors that support risk asset buying and allow an environment for risk assets to flourish. And in this case, when I say risk assets, I'm talking about crypto. That would be dovish remarks from Federal Reserve speakers, economic indicators signaling a contraction or displaying economic weakness in the United States, such as higher unemployment claims, and notably lower inflation ratings, are all catalysts that foster a risk-on market sentiment. These factors fuel optimism in risk assets like stocks and cryptocurrencies while simultaneously exerting downward pressure on the dollar. So here you guys can see an upward trajectory or an uptrend because these factors most likely lead to risk asset buying, more risk appetite, and riskier assets like crypto, as investors hedge against a depreciating dollar. Conversely, it is crucial to recognize the factors that can undermine the rate cut narrative. Elevated inflation levels, robust or resilient economic data from the US, a stronger labor market, or hawkish comments from the Federal Reserve all contribute to the dollar's strength and foster a risk off market mood and sentiment. In such scenario, investors tend to shift their focus towards the dollar, moving away from riskier assets like crypto. Furthermore, we also have to take into accountability geopolitical tensions escalating globally can also exuberate this risk off market sentiment, prompting investors to seek refuge in safe haven status of the dollar. This flight to safety can further bolster the dollar's strength while dampening the appeal of risk assets. So, these are some factors that contribute to a decline in the price of risk assets. And it's imperative that you understand these factors moving forward as we go through this video breakdown. Again, we go over all this information in detail in our private CYPRX community with not only Zoom calls on a weekly basis of 2 to 5 Zoom calls per week. We also have fundamental PDFs. We have video recorded material about this information. So that way, people that come into our community can actually learn these things and understand how to adjust their portfolios according to market conditions, whether it's an optimistic perspective or a pessimistic perspective, particularly pertaining to risk assets. Okay. So now that I've mentioned to you guys, if you want to see the bullish side of this, how we got to a $2.7 trillion market cap, go back and watch this video breakdown. Now that you all understand what you need to know before we jump into this video breakdown, we're going to start at the top. And I'm going to physically show you guys fundamentals that came out at particular key dates that started to weigh on the risk asset class as a whole, leading up to where we are at in time now. So we're going to go back to Tuesday, the 12th of March, 2024, when the market topped out. You can see the dates on the fundamentals, Tuesday, March 12th. This is a screenshot directly from forexfactory.com. We had core CPI month over month, CPI month over month, and CPI year over year come out elevated from previous and forecasted readings, right? Now, this is a fundamental piece from a large financial institution, Morgan Stanley. Investment Management labeled the beat. This is from March 2024. And in this, it goes on to talk about how elevated inflationary readings create more of an appetite for the dollar and less of an appetite for risk assets. So I don't want you all to think, because I know I'm going to get those people in the comments that are like, oh, fundamentals don't have anything to do with price action. Oh, da. And I'm expecting $100 XRP tomorrow. Let's wake up, ladies and gentlemen. And if you've been a follower of the work that we commit ourselves to at CYPRX, you have to understand we are intraday traders primarily here at CYPRX. We're not just investors. As an investor, you should understand this information because this is why you're seeing an outflow of risk assets and an inflow back into dollar. So these are key talking points pulled from the document from Morgan Stanley. So remember, on Tuesday, March 12th, we had higher inflationary readings from the United States, right? CPI came out elevated. And so let's dive into what effect this has on the market. So the Consumer Price Index, or CPI data release on March 2nd, 2024, showed that inflation remained elevated in February, with prices rising to 0.4% from the prior month and 3.2% from a year earlier. This was slightly higher than the 3.1% annual rate seen in January. The core CPI, which excludes volatile food and energy prices, also rose to 0.4% in February after a similar increase in January. The higher than expected inflation data suggests that the path to lower consumer price increases may continue to be gradual. This led to speculation that the Federal Reserve may wait longer before cutting interest rates, as they had previously signaled they would do. The prospect of the Fed maintaining higher interest rates for longer in an effort to further tame inflation made the US dollar more attractive to investors. So remember, This happened at the same exact time that the market topped out. So we can clearly see an outflow of risk assets. And if you go and you look at the dollar index, was the same exact time that the dollar index bottomed out and started to see an increase in value. Again, resulting back to this first document that I just shared with you guys, understanding these macro factors. So on March 12th, when the market topped out at roughly about $2.7 trillion, we started to see a risk off market environment created. Following the next day on Thursday, the following day on Wednesday, March 13th, we had yet another high US inflation gauge coming in hot for February. Rising energy prices helped to fuel yet another hot inflation reading for February. Now remember, this data is lagging behind. So the data that came out in March was for February. That's why it's saying February, for those of you all who are new to fundamentals. A closely watched gauge of the US wholesale inflation rose at its fastest pace in months, according to a new data release on Thursday. While a seasonal energy price surge is at the root of the gain, and a less volatile category are showing signs of continued cooldown, the latest producer price index, i.e., PPI, is yet another reminder of the arduous process to rein in on inflation, right? So we saw higher PPI figures come in. And again, remember, resulting back to this fundamental piece, we know that one of the things that weighs on risk sentiment is higher inflation, or a pushback in the rate cut narrative, which prompts a risk off market mood and drives strength for the dollar. Okay, so we saw that happen on Wednesday, leading into Thursday, back in March when the market topped out. Okay, now we also had that same exact week. Unemployment insurance weekly claims, March 14th. So you can see down at the bottom of my screen, March 14th, that was a Thursday. We had unemployment claims in the week ending in March 9th, the previous week. So remember, again, fundamentals lag behind. The advanced figure for seasonally adjusted initial claims was 209,000, which was a decrease of 1,000 from the previous reading. So we saw a decline in people filing for unemployment claims. Remember, one of the factors that weighs on risk assets is strength in the labor market or lower unemployment claims, less people filing for unemployment, needing support from the government or stimulus, right? So I have this piece here for you guys. So that way you firmly understand. Lower than expected unemployment claims data suggests the US labor market remains robust, which would be seen as a hawkish signal for the Federal Reserve's monetary policy. This is because a stronger labor market makes it less likely that the Fed will need to cut rates in the near future, as they had previously signaled they would do. The prospect of the Fed maintaining higher interest rates for longer in an effort to further tame inflation makes the US dollar more attractive to investors. We already went over that. We're not going to beat a dead horse. So, again, remember the contributing factors driving risk sentiment and pumping up the risk asset class as a whole. In this scenario, we're talking about the total cryptocurrency market cap to $2.7 trillion has been weighed on by these upbeat fundamentals. Again, if you guys want to go back and watch how we got to this point, the supporting fundamentals that drove a risk on sentiment, go back and watch this video. Now we're talking about the opposite. We're really picking apart why we started to see the market top out and investors shift their capital back into the United States dollar and out of risk assets. So that was the week from roughly around Monday, March 11th, all the way up into Friday, March 15th. Heading into the next week, the predominant factor as to why we saw a recovery in risk assets, as you can see on the screen, the market bottomed out roughly on around Wednesday, March 20th, and leading up into the 31st on Sunday, March 2024, before we saw a sharp decline again. Let's go over this week's worth of price action and what contributing factors weighed on price. All right. So overall, let's start here. On Wednesday, March 20th, 2024. Why did we see a recovery in risk assets? As you all can see, the cryptocurrency market created a nice market maker pattern, pre-engineered low, liquidation of that low, higher low that comes in after. Where did that higher low come in after at price? Look down at the bottom of my screen. You can see Wednesday, the 20th of March. What happened? Well, on this day was the FOMC release. right? On Wednesday, March 20th is when the FOMC took place. You can see the US dollar dips on a dovish sentiment from Jerome Powell. The US dollar was notably lower after what was seen as a dovish commentary from the FOMC meeting on Wednesday. The Fed 2024 median dot was left unchanged, with 3 rate cuts for 2024 still in the Fed forecast. But the dovish part came in at the presser, where Fed Chair Powell downplayed the hot January and February CPI figures. This dovish tilt saw risk assets. So I'm not making this up. You see this right here. It says this dovish tilt saw risk assets surge and the US dollar dump, right? So we saw risk assets recover. We saw stocks recover. We saw the S&P 500, so on and so forth, recover. And that was due to the commentary and the rate cut narrative that was delivered from Jerome Powell on the FOMC day. Now, the next day, on Thursday, we saw that narrative further weighed on, and this was due to 3 upbeat fundamental data reports that we got on the following day, on Thursday, March 21st. So, starting with this one, we had some upbeat PMI figures, where the U.S. manufacturing activity actually expanded by the most since June 2022. The U.S. manufacturing activity expanded by the most since mid-2022 as productions and factory unemployment growth accelerated along with measures of inflation. The S&P Global Flash March Factory Purchasers Managing Index, or the PMI for short, edged up a 0.3 point to 52.5, marking the 3rd straight month above a level of 50 that indicates expansion. Now, remember in the breakdown, I mentioned to you guys that any expansion in economic activity usually weighs on the price of risk assets and boosts the strength of the dollar. And we can see that reflected in the total cryptocurrency market cap. Now, why am I using the total cryptocurrency market cap? So that way nobody underneath in the comments can say, oh, Bitcoin did this or XRP did this on that day and da 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 da. No, it was the total cryptocurrency market cap as a whole, including Bitcoin and XRP and any other digital asset that you favor, right? You can see the outflow of risk assets due to the upbeat data and the strength in the dollar. Now, on that same exact day, you can see the date, March 21st. We also had manufacturing activity in the region continue to expand. Not only that, but on that same exact date, you can see U.S. initial jobless claims ease and signs of a resilient labor market on March 21st, 2024. The initial applications for the U.S. unemployment benefits held near historical lows last week, underscoring the resilience of the U.S. labor market, right? So remember, a healthy labor market gives strength to the United States dollar and weighs on risk appetite. And you can see that reflected in the total cryptocurrency market cap. Looking down at the bottom of my screen, you can confirm that this was that Thursday, March 21st, outflow of risk assets, inflow back into the dollar. Now, the market bottomed out again on Friday, the following day, March 22nd, and this was primarily driven to a tolerant Jerome Powell, again signaling to the market that he sees rate cuts taking place in 2024. You can see the date of this article. I believe this is a Bloomberg report from March 22nd, 2024. All tolerant Powell sends Wall Street into a buying frenzy. Interestingly enough, the statements from Jerome Powell's speech on that Friday took place right when the market bottomed out, where he re-emphasized the narrative surrounding rate cuts taking place in 2024. And you can see the effect positively that rate cuts or that narrative had on the overall cryptocurrency market capitalization as a whole, as we flipped bullish and slightly recovered from the previous downtrend that was exerted on the cryptocurrency market from the previous week's fundamentals. All right. So that now leads us up into the second week before we cover the most recent week in price action. So heading into April, all right, this was Monday, April 1st. I remember this day particularly because everybody was freaking out, wondering why over the weekend we saw a recovery in risk assets from the previous week when Jerome Powell delivered the initial statement that he still sees rate cuts happening, re-emphasizing what he said in his speech from the FOMC release, where we saw a recovery in risk assets. Everybody and their grandma was confused as to why risk assets started dumping again. And this was again primarily driven by upbeat US fundamental data, where we can see on Monday, the US dollar jumped again after upbeat US manufacturing figures. So we had some more PMI figures. The US dollar posted strong gains after a stronger than expected US manufacturing survey triggered fresh doubts whether a June Federal Reserve interest rate cut was realistic. This again was a fundamental piece that was released on Monday, and we can see the exerted downward pressure that had on risk assets, as on the same exact day we saw inflow into dollar and outflow of risk assets, as we again saw another fundamental piece supporting strong economic activity in the United States, right? So on this day, if you were one of those investors that was confused as to why your portfolio was in the red, here at CYPRX, we were covering these fundamentals a day in advance, where we give our fundamental breakdowns the night before to prep our members as to what could potentially take place the next trading day. So we were well aware of what happened this day ahead of the curve. Leading into the next couple of trading sessions, why did we see a recovery again? Right? So again, just like the last week, the previous week, right? We saw a drop in price, and then we saw a recovery in price. Why was this? This drop in price, if you remember the breakdown we just went over, was due to upbeat fundamentals, higher inflationary readings, upbeat labor market data, high PMI figures showing expansion. Then the market bottomed out when Jerome Powell came in and supported the rate cut narrative, signaling to the market that 3 rate cuts were still on the table, delivering dovish commentary, boosting risk sentiment again. Well, at the beginning of this week, we saw that narrative weighed on by upbeat fundamentals, but then midweek, why did we see this recovery that you're seeing on my screen? Okay. Why did we see the market bottom out? Where did it bottom out at? And where did it stop bottoming out at, top out, and flip bearish again? Let's go over that. So on Tuesday, April 2nd, we had some speakers from the Federal Reserve, particularly Fed Mester, who went on to further support the rate cut narrative, where you can see this fundamental piece says Fed Mester still expects rate cuts this year, but rules out a rate cut in May. Now, remember again, supporting fundamental factors that drive strength or demand for risk assets are dovish remarks from Federal Reserve speakers supporting rate cuts, right? So you can see that is exactly where the market, i.e. the total cryptocurrency market cap as a whole, bottomed out. On the same exact day, we also had another Fed speaker, Fed Daily, saying that she also sees rate cuts happening in 2024. You can see Federal Reserve, Bank of San Francisco, President Mary Daly said 3 interest rate cuts are a still reasonable expectation for 2024. This type of tone, a dovish tone, supports rate cuts, boosts risk appetite. So that day we saw outflow of dollar and inflow back into risk assets. The following day, on Wednesday, you can see some commentary from Jerome Powell supporting that rate cut narrative as well. Now, don't be intimidated from these vertical lines on my charts. They are just an indicator that determines where the New York, London, and Asia session opens at. Okay, that's what these vertical lines are. So that way you all can physically see that these fundamentals are coming out during New York session. Okay, so during New York session on Wednesday, April 3rd, the day after we saw the crypto market as a whole bottom out due to some supportive commentary from Fed speakers, we also saw that narrative continue with Jerome Powell saying that he doesn't think inflation is reversing higher. Obviously, of course, it was, but because Jerome Powell said that he thinks it's not, that is seen to the market as a dovish comment, and we know dovish comments support a risk on market environment. He also mentioned, under current economic outlooks, rate cuts are still likely appropriate this year. Stronger data hasn't materially changed the overall outlook. These are supportive fundamentals that will drive sentiment for risk assets or demand for risk assets and less of a demand for the dollar. And you can see on that Wednesday when he delivered these comments, we saw a bullish turnaround in risk assets. Now, the following day on Thursday, you can see New York session opened at 5:30 a.m. on this Thursday, April 4th, New York session. What data did we have that weighed on the strength of the dollar and boosted risk assets up to about $2.5 trillion total in cryptocurrency market cap? Well, you can see here the date of this screenshot is the 4th of April, where we had the US initial jobless claims went up more than anticipated last week. So we actually had an increase in people filing for unemployment claims, where the initial jobless claims rose by 221,000. This shows signs of weakness in the labor market as more people are filing for unemployment claims. Whereas in the previous week, if you all remember, back from when the cryptocurrency market cap topped out, right? You guys remember here. Back in March, we saw less people filing for unemployment claims, right? And I went over that breakdown for you guys here. What that signals to the market. So conversely, when more people file for unemployment, you see right here, such as higher unemployment, this signals a risk on market mood as it weighs on the strength of the dollar and signals to the market and that there is dwindling strength in the labor market, right? So that happened on this day. Looking at the bottom of my screen, you can see that this was a New York session, and at 5:30 a.m., the market flipped bullish for risk assets. Following the next trading session, what did we have? The employment situation. Now, this was a Friday. This was last Friday. If we look down at the bottom of my screen, this was the 5th of April, 2024. What fundamentals did we have come out? We had the NFP and we had the unemployment rate come out robust and upbeat, where the total non-farm employment rose by 303,000 in March, and the unemployment rate change went down from 3.9% to 3.8%. This shows signs of a healthy U.S. labor market. However, if you remember the previous day, Jerome Powell said that stronger data has not materially changed the outlook of rate cuts from the Federal Reserve. So over the weekend, the market, being greedy, held on to the rate cut narrative, although we saw upbeat fundamentals on that Friday driving strength temporarily to the US dollar. We still saw a recovery in risk assets, and you can see that here. This is Friday's price action. This is Saturday's price action, and this is Sunday's price action. So the market held on to what Jerome Powell says, that even though we see upbeat data, we're still signaling to the market that at some point in time in 2024, the Fed is going to usher in rate cuts. And you can see that reflected in fundamentals. Strong U.S. jobs data failed to sustain the dollar rally. The March U.S. employment data, stronger than expected, lends supports to the re-acceleration and hypothesis of an extension of U.S. exceptionalism. So you can see that even though the robust economic data for the U.S. came out, the market is still holding on to that rate cut narrative. So anytime that we see weight on that rate cut narrative, we're going to see an outflow of risk assets and an inflow into dollar, which leads me up to this week. Why are we seeing a decline in prices of risk assets across the board? Why is your portfolio red? Again, I see no other influencers, especially the big ones, telling you all that prices are going to go to freaking brand new all-time highs in this current environment that we operate in, which it's not anytime soon unless this market environment that we operate in changes hands. Keep that in mind. We are in a trading environment. These digital assets, especially the ones that I have in my portfolio, which are all utility assets, are not being utilized for their utility right now. So with that being said, we have to treat them as tradable assets, which is what they are, which is what all of these hedge funds and asset managers and private family offices are treating them as. And we have to understand the macro. So why this week did we see an outflow of risk assets. Now, you guys know, I don't want anybody in the comments to be like, oh, you're wrong. Prices are going to go to new all-time. I hope so. I hope that one day everything flips bullish and we can live in a fairy tale land where prices just go up for forever, but that's not realistic. In order for this trading environment in which we operate in now, for us to see higher prices on digital assets, the environment must flip optimistic. It must flip risk on. Okay. With that being said, what weighed on risk sentiment this week? Well, to start the week off, the week was pretty dry via fundamentals on Monday and Tuesday. The market was, respectively speaking, just gearing up for Wednesday FOMC meeting in minutes. Now, in the FOMC meeting in minutes that was delivered on Wednesday, April 10th, you can see indicated by this New York session vertical line, the market had a slight recovery from the downturn that we saw on Monday and Tuesday, the beginning of the week. Now, why was this? So you can see this is a fundamental piece directly from Bloomberg. And there's some highlighted notes here, and I'm just going to read some of the highlighted notes. There was a risk on market sentiment that was delivered on Wednesday due to these supporting fundamental highlights. So we're just going to go over this real quick. Let's read this, and then we'll recap the remainder of the week. So one key highlight from the Federal Open Market Committee, or the FOMC meeting in minutes that took place on Wednesday this week, is that the policymakers generally favored slowing down the pace at which they are shrinking the central bank's asset portfolio by roughly half. This indicates a more cautious approach towards reducing the size of the Fed's balance sheet, known as quantitative tightening, or QT. Slowing down this process could be seen as supportive of risk assets because it suggests that the Fed may be lessening its impact on the market by reducing the supply of securities it holds, which could potentially provide more liquidity to the financial system. I want you to pay attention to that one key sentence, because remember, back in 2020 up until the top in 2021, why did we see a bull market cycle? Because the Fed was injecting liquidity into the market. They were stimulating the economy. They were quantitatively easing the economy, right? So if this is signaling to the market that they could potentially provide more liquidity to the market, to the financial system, what does that cause? That creates a risk on market environment, right? Now, this decision reflects a recognition of market turmoil experienced in the past when the Fed attempted to shrink its portfolio too quickly. Additionally, the minutes also showed that almost all officials judged it would be appropriate to begin lowering borrowing costs at some point this year. Lowering borrowing costs, typically through interest rate cuts, which we know has been a narrative driving demand in risk assets, can stimulate economic activity and investor confidence, which could also support risk assets. Overall, these are the economic indications from the FOMC meeting in minutes, suggesting a more accommodative stance from the Fed, which could be interpreted as favorable for risk assets like stocks and crypto. And you can see on that Wednesday, looking down at the bottom of my screen, we saw that risk on market sentiment. Now, why did that sentiment change hands midweek? Why did we see the cryptocurrency market capitalization top out at roughly about 2.58 to 2.59 trillion, leading us up into the decline in which we're seeing today? Let's go over that real fast. So on Thursday, April 11th, midweek, what did we see? We saw two Fed speakers deliver hawkish commentary. Remember, in the breakdown that I gave you guys, hawkish comments from the Federal Reserve will likely contribute to dollar strength and foster a risk-off market mood, right? Or a decline in the valuation of crypto assets. What you can see right here. Fed Barkin went on to say that the Fed is not yet where they want to be on inflation. When the previous week, Jerome Powell said that he doesn't see higher inflation as a problem. Other Fed speakers see the opposite. They're seeing, obviously, of course, that higher inflation is a problem and that the Fed is in no place at this current moment in time to cut rates, which weighs on the what? On the rate cut narrative, which we know, obviously, of course, after hearing me speak and breaking this down for you guys and watching this previous video breakdown, has been one of the narratives driving demand in risk assets. So anytime that that's weighed on, we see an outflow of risk assets and an inflow into dollars, right? We also saw Fed Williams say that there is no need to adjust rates in the very near term. You can see the date on this. This is from Bloomberg, and this is from Thursday, April 11th. This is another fundamental piece that weighs on the valuation of digital assets, supports a further pushback in the rate cut narrative, and strengthens the dollar. Here, we saw a slight recovery of risk assets midway through the Thursday session, and this was primarily driven to the downbeat PPI figures that we saw. You can see on April 11th, the S&P 500 and the Nasdaq end sharply higher on soft inflation data. Why? We saw again the PPI figures on April 11th come out lower. The US PPI inflation report for March was released today. The report was expected to show an acceleration in the headline as well as core producers inflation. However, as we've already received the CPI data for March, the PPI report was expected to have little impact on the markets. Sure enough, that little tiny decline in inflation in the PPI figures showed a slight recovery in risk assets that was extremely short-lived. Now, why was it short-lived? Rolling over into Friday's trading session today, where we currently stand at this moment in time, we are seeing ongoing geopolitical escalations and obviously, of course, the dwindling narrative that the Federal Reserve is going to cut rates. Remember, I mentioned to you guys in this last piece. Furthermore, geopolitical tensions escalating globally can create a risk-off market sentiment, prompting investors to seek refuge in safe haven status of the dollar. Look at these fundamentals, all right? You can see the date. This is from Reuters. The dollar up on mixed central bank views and Middle East risks lifting oil and gold, i.e. safe havens. April 12th, 2024. The US dollar soared on Friday while oil prices pushed higher and gold reached a record peak as investors grappled with ongoing geopolitical tensions and potentially diverging interest rate paths between Europe and the United States. So we can see the dwindling narrative that at some point in time, the Fed is going to cut rates due to what? Higher inflation, upbeat labor market figures that we saw previous weeks, and hawkish Fed comments. Now, couple that with ongoing geopolitical escalations, which we know further strengthen the dollar and weigh on risk assets. How do we know this? If we go back and we look at when, for example, Bitcoin topped out, okay? Let's just go back and look at this. I want to physically freaking show you guys this because not a lot of people understand this. Remember, geopolitical tensions weigh on the strength of risk assets. If we go all the way back in time to back in 2021 November, when Bitcoin topped out at roughly around 69,000, all right? I just want to physically show you guys this. This is all information that anybody can go and look. When Bitcoin topped out at 69,000 and started its decline, that is the same exact month that the Federal Reserve announced interest rate hikes and then started hiking at a rapid pace, the most rapid pace that we've ever experienced in our lifetime. But at the same exact time, check this out, November 2021, Russian troops spotted on Ukraine border. Look at this. For the first time ever, we saw satellite images show new Russian military bound up by the Ukrainian border. This was on the 1st of November, 2021. And we know geopolitical escalations create a risk-off market environment. So investors start to flock towards safe haven assets. At the same exact time, we saw strength in the dollar, outflow of Bitcoin, inflow into safe haven, the dollar. Same thing we're starting to see now. And I'm not sitting here calling for another bear market cycle. I'm just trying to educate you guys as to why the total cryptocurrency market cap as a whole is declining in value, right? So if we head over here, we can see a massive bearish candlestick that took place today. Let's go down to the lower time frame. Okay. And look at this. Look at the freaking date of these articles. This is from Reuters. This is on the same exact date. Well, the United States expected an attack by Iran against Israel, but one that would not be big enough to draw Washington into war. So there are still ongoing geopolitical escalations. The U.S. official said late on Thursday, look at the time, look on Thursday, look at this. Okay, this is why I'm showing you guys this. Look at the late on Thursday, all right? Late on Thursday is literally right here when the market topped out. So you can see the geopolitical escalations, the announcements. We know the effect that that has on risk assets. And so now you all are aware as to why we're seeing an outflow of risk assets and an inflow. If you go look at the dollar, and an inflow into the dollar, right? Dollar strong, risk assets at current time of recording this video are weak. And it is because of, again, the dwindling rate cut narrative being pushed back further and further due to upbeat US economic data, hawkish comments from Fed speakers, and higher inflationary reports. Couple that with ongoing geopolitical escalations and tensions that drive demand for the safe haven status of the dollar. So here at CYPRX, we're in an attempt to really wake you all up, educate you all on what's happening in the market. I physically just showed you guys pinpointed fundamentals from these specific dates and times, showing you guys the price fluctuations of these digital assets, the total cryptocurrency market cap as a whole. We're not excluding meme coins. We're not excluding Bitcoin or anything. This is the entire market as a whole. Okay. With that being said, again, make sure that you guys go back and educate yourself on why we even got to $2.7 trillion by watching this video breakdown. Do us a favor, smash that thumbs up button, subscribe to the platform. So much valuable information and content on the CYPRX YouTube. As always, many blessings to you guys. Hopefully you all learned something and you are one of those investors or traders that is actually looking to further educate yourself and enlighten yourself on current market dynamics so that way you can adjust your strategies and your portfolios accordingly. As always, many blessings to you guys. Be cognizant, be aware out there, share this video breakdown with other like-minded individuals that are looking to learn about this space more in detail. If anybody wants access to our private community where we go over all of this stuff on a daily, a weekly, and a monthly basis, keeping our community engaged and in the know, then visit CYPRXtrading.com. We have about 68 slots left for our monthly membership where you guys have direct access to all of our Zoom calls, all of our fundamental and technical analysis breakdowns, and obviously, of course, all of our Discord educational material. With that being said, I will see you all in the next video breakdown.